Usually when we talk about a medical diagnosis, there's this comforting expectation of clinical precision.
Right. It's very black and white.
Exactly. Like,
Yeah.
if you fall and hurt your arm, the doctor takes an X-ray, points to a jagged white line on the film and says, there it is, clean break. It's totally binary, broken or not broken.
Yeah, it provides certainty. I mean, the whole framework for diagnosis in medicine, well, at least in orthopedics, right? It relies on visible, undeniable physical evidence.
But then you step into the world of financial reporting, and suddenly that X-ray machine is calibrated completely differently.
Oh, absolutely.
We're no longer just looking at hard physical assets or, a simple snapshot of cash in a bank account. We're looking at this diagnostic landscape that's just filled with shadows, management intentions, deeply complex legal timelines, and standard overrides.
And standard overrides are where things get really tricky.
Right. And a simple shadow, if it's misread, can completely alter the diagnosis of a company's entire financial health.
I mean, it's pretty much the absolute definition of diagnostic muddy waters. And the real danger there is that a misdiagnosis on a balance sheet doesn't just affect one patient, It cascades down to investors, to creditors, and really the entire market ecosystem.
Which brings us to the core of our analysis today. So, welcome to a new deep dive on the Gap Advisors Ind AS Clinic podcast. Today, we're not looking at a massive fraud or some billion-rupee accounting scandal.
No, nothing that flashy.
Right, exactly. We are tearing apart a single, seemingly harmless disclosure note. One perfectly innocent-sounding sentence that was found in the published financial statements of a listed company.
Yeah, just one sentence.
Our mission today is to demonstrate how this one sentence, literally just a few words, unravels the entire presentation of their balance sheet.
And, to set the context for our analysis today, the observation we're dissecting comes directly from published Ind AS financial statements of a listed company.
Which is fascinating because these are published, signed off on.
Exactly. And these were downloaded and independently reviewed by DAP advisors on a suo motu basis, meaning we just went in and looked at them on our own initiative.
And for those of you who follow the literature closely, this specific observation was actually featured in the 235th edition of the Gap Advisors Task Weekly newsletter.
Yes, it was a great addition.
That newsletter is authored by C.A. Menish C. Iyer, Director of Gap Advisors, and is published right there on LinkedIn. I think they have over 230 editions published to date.
Yeah, we're well past 230 now.
Right. And honestly, if you're operating anywhere in the Indian corporate finance space, subscribing to that free newsletter on LinkedIn is, well, it's practically a professional prerequisite at this point.
I'd agree with that. So before we reconstruct this balance sheet and analyze the actual error, let's just establish the foundational parameters for the financial statements we're discussing so everyone's on the same page.
That's good. Give us the ground rules.
First, we are operating with the Indian rupee, or INR, as both the functional and presentation currency. So by definition, under the standards, any other currency introduced into our scenarios today is considered a foreign currency.
Okay, got it. INR is king.
Right. And furthermore, the reporting period we're referencing is the standard Indian fiscal year. So that's beginning on the 1st of April and ending on the 31st of March.
Which, as we'll see, those dates are going to become critically important as we get deeper into this analysis. The timeline is everything.
The timeline is absolutely everything.
So let's look at the incriminating note itself. This was pulled straight from the company's basis of preparation and presentation. I'm just going to read the exact disclosure so we have it. Quote, all assets and liabilities have been classified as current or non-current as per the company's normal operating cycle and other criteria set out in the Schedule 3 to the Act. End quote.
I mean, to a casual reader, it sounds incredibly authoritative.
It does. It cites the Companies Act, it mentions the normal operating cycle, and it references Schedule 3. It projects this aura of complete compliance.
Yeah, but that's exactly the trap. It sounds fine until you actually know the framework.
Right. So I've been looking at the general instructions for preparation of financial statements of a company, specifically the ones required to comply with Ind AS. And if you look at Division 2 of Schedule 3 to the Companies Act, 2013, specifically Clause 2, it seems to act as this explicit override switch.
It absolutely does.
Like, it basically says that if Ind AS demands a change in treatment, Schedule 3 just bows out. Is that interpretation too aggressive, or does Ind AS literally modify the law in this specific context?
Oh, it's not aggressive at all. I mean, it is the literal legal framework. Clause 2 specifically states that where compliance with the requirements of the Act, which obviously includes Indian accounting standards, required as any change in treatment or disclosure, Ind AS prevails.
Even if it means substituting or deleting things.
Exactly, including any addition, amendments, substitution, or deletion in the head or subhead, or any changes in the financial statements. The exact phrasing literally commands that the requirements under the schedule shall stand modified accordingly.
Okay, so to put a structural analogy to this, just so we can visualize it, it's somewhat like a local city ordinance trying to dictate traffic laws on a massive federal highway, right?
That's a great way to think about it.
Yeah, so the city might post a sign saying, the speed limit is 80 kilometers per hour, but the Federal Highway Authority has a comprehensive law stating the limit is 60. And furthermore, that federal law includes a supremacy clause stating it explicitly supersedes any local ordinance.
Right.
So when the two clash, the federal law doesn't just win. The local law is essentially rewritten in that specific jurisdiction. In this scenario, Ind AS is the federal law.
That is the perfect way to conceptualize it, yeah. If Ind AS 1 dictates a specific classification mechanism for an asset or a liability, and Schedule 3 dictates something seemingly different or maybe more rigid.
Schedule 3 is just automatically modified.
Exactly. Modified by the authority of the accounting standard.
Which means our listed company basically anchored their ship to the completely wrong dock.
They really did.
By explicitly and solely tying their entire classification of current and non-current items to the, quote, criteria set out in the Schedule 3 to the Act, they failed to acknowledge that Ind AS override.
Yeah, it's a huge omission.
But let's move beyond the theoretical governance side of this and look at the practical, numerical consequences. Let's trace the mechanics of this clash right on the balance sheet, specifically concerning trade receivables.
Okay, yeah. To understand the distortion this causes, we really first have to analyze the concept of the operating cycle. And that's codified in paragraph 68 of Ind AS 1.
Right, because the company did actually mention their normal operating cycle in their disclosure note. So let's look at the actual life cycle of a business, like what standard setters are actually trying to capture here.
Sure, paragraph 68 essentially defines this as the time between the acquisition of assets for processing and their realization in cash or cash equivalents.
So it's the complete journey of working capital.
Exactly. Imagine a heavy machinery manufacturer. Let's call them Titanium Forge Ltd.
Okay, Titanium Forge.
Right. So they purchase raw steel. They spend, say, 6 months engineering and building a massive custom industrial turbine. Then they deliver it to a client. And then, based on their standard industry contracts, they might give that client another 10 months to finalize the payment.
Wow. Okay, so that's a long time.
Yeah, their normal operating cycle from buying the steel to actually collecting the cash is 16 months.
16 months.
Right. And AS1 includes a default provision. If the entity's normal operating cycle is not clearly identifiable, it's automatically assumed to be 12 months. But for our Titanium Forge example, it is clearly identifiable. It's 16 months.
And this is exactly where the conflict with Schedule 3 creates a massive trap, isn't it?
It really is.
Because Schedule 3 attempts to draw this hard line in the sand. It classifies trade receivables into current and non-current buckets, primarily based on a very rigid 12-month realization timeline.
Yes.
But Ind AS 1 takes a completely different philosophical stance regarding working capital. Like paragraph 68 explicitly states that current assets include assets, and it specifically highlights inventories and trade receivables that are sold, consumed, or realized as part of the normal operating cycle.
And the really critical distinction follows immediately in the text of the standard. They are classified as current even when they are not expected to be realized within 12 months after the reporting period.
Right, so let's test that logic with our hypothetical Titanium Forge Ltd. Let's say they have a massive receivable sitting on their books on March 31st, like a 500 crore rupee invoice for a completed turbine.
Okay, a big chunk of change.
Huge.
Yeah.
But because of their 16-month operating cycle, they don't actually expect to collect that 500 crore until, say, July of the following calendar year, which is well beyond that 12-month cutoff.
Right, it's past the 12 months.
So if they blindly follow the criteria set out in Schedule 3, which they said they did in that note, they would classify that 500 crore as a non-current asset.
Which would fundamentally distort their liquidity ratios. I mean, it completely breaks the picture. Under Ind AS 1, because trade receivables are inextricably linked to the working capital used in the normal operating cycle, they are always current assets.
Always.
Always. And paragraph 70 mirrors this exact logic for the liability side, stating that operating items like trade payables and operating accruals are classified as current even if they're due to be settled more than 12 months after the reporting period.
So it's symmetric.
Very much so. The standard is absolute here. The same normal operating cycle applies to the classification of an entity's assets and its liabilities.
So if Titanium Forge follows Schedule 3, like our listed company claimed to do, and they move 500 crores to non-current assets, their current ratio just plummets.
It falls off a cliff.
Right. A bank evaluating their short-term health might see a working capital deficit and just flat out reject a short-term financing facility.
Or jack up the interest rate because they look incredibly risky.
Exactly. And conversely, if an auditor forces the correction and applies the Ind AS 1 override, that 500 crore moves back into current assets. But then an uneducated investor might look at that massive current assets number, assume the company is flush with near-term cash, and miscalculate their immediate liquidity.
Yeah, they wouldn't realize that cash is locked up for over a year.
It's wild. The ripple effects of the single misclassification are just enormous. It alters covenant calculations, impacts working capital financing limits, and completely skews the analytical models used by institutional investors.
It does. And, the documentation burden for auditors navigating these specific standard overrides must be incredibly intense.
Oh, I can't even imagine. You can't just move 500 crores across the balance sheet based on a whim.
No, you need rock-solid, citable justification. The audit working papers have to comprehensively document the evaluation of the operating cycle, the identification of the conflict between the standard and the act, and the explicit application of Clause 2 of Division 2 of Schedule 3.
Which is a prime example of why professional resources are so critical in this space. And really, navigating these highly specific Ind AS conflicts is exactly why the issue repository on gapadvisors.com exists.
It's an incredible resource.
It really is. The platform hosts over 4,500 issues and responses on Ind AS and Indian GAAP. And what's great is that any person can register for free and submit issues on Ind AS and Indian GAAP for a detailed response, which is delivered directly to their inbox, the email they registered with at gapadvisors.com.
Yeah, it's highly specific, too.
Exactly.
Yeah.
I mean, if an audit team is staring down a CFO who insists on classifying a 15-month receivable as non-current just because Schedule 3 says so, having access to a repository of documented peer-reviewed responses on how to apply the Ind AS 1 override is an absolute lifeline.
It really bridges the gap between theoretical standard interpretation and practical defensive audit documentation. You need that paper trail.
You definitely do. All right, let's transition into an even deeper layer of classification complexity, because we need to analyze the August 2025 amendment and the profound impact of deleting literally a single word from the standard.
Ah, yes. The famous missing word.
Yes. But to understand the shift, we have to look at the historical context first. Prior to August 13, 2025, Ind AS 1 and Schedule 3 were actually perfectly aligned regarding the classification of current versus non-current liabilities.
They were. They operated on the exact same premise. But the landscape shifted dramatically with notification GSR 549E, which amended paragraph 69D of Ind AS 1.
Okay, let's do a forensic comparison of the text here. Under the old rules, and currently under Clause 3 of the General Instructions for Division 2, Schedule 3, the criteria for classifying a liability as current hinges on a very specific phrase.
What does it say?
It states, a liability is current when the entity, quote, does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period.
Right. And the operative word there is unconditional.
Unconditional. Now, looking at the amended Ind AS 1, paragraph 69, criteria D, the standard dictates an entity shall classify a liability as current when it does not have the right at the end of the reporting period to defer settlement of the liability for at least 12 months after the reporting period.
They surgically removed the word unconditional.
They just deleted it. And that is not a minor editorial cleanup, is it? The implications of removing that conditionality threshold must be absolutely massive for long-term debt structuring.
Oh, it changes everything. The historical inclusion of the word unconditional created severe unintended consequences.
Really? Like what?
Well, let's build a scenario to illustrate why the standard setters had to act. Imagine a company, let's call them Apex Infrastructure.
Okay, Apex.
Right. They secure a 10-year, 1,000 crore rupee syndicated loan to build a major toll road. Now, no bank issues a 10-year loan without attaching covenants.
Right. There are always strings attached.
Always. These are financial guardrails, such as requiring Apex to maintain a specific debt service coverage ratio, or maybe a maximum debt-to-equity ratio.
Okay, so because those covenants exist, Apex's right to defer the repayment of that 1,000 crore loan for the next 10 years is inherently conditional upon them meeting those financial targets every single quarter.
Yes, and that was the trap. Under the strict textual interpretation of the old rule and Schedule 3rd, because the right was conditional, Apex did not have an unconditional right to defer.
Oh, wow. So they failed the test immediately.
Exactly. Therefore, audit firms, adhering strictly to the letter of the standard, were forcing perfectly healthy companies to classify massive 10-year infrastructure loans as current liabilities on their balance sheets.
Which would instantly destroy their current ratio and likely trigger cross defaults on their other credit facilities too.
It was a disaster. It created an artificial liquidity crisis on paper, which was completely divorced from the economic reality, because the bank had no intention of calling the loan as long as the toll road kept operating and they hit their basic numbers.
Okay, that makes perfect sense. So by removing the word unconditional, the amended Ind AS 1 realigns the accounting treatment with the actual economic substance of the arrangement.
Yes, exactly. The question is no longer whether the right is free of all conditions. The question is simply whether a substantive right to defer exists at the measurement date, which is the end of the reporting period.
And once again, this is where the Ind AS override applies, right? A liability that Schedule 3 demands be classified as current due to the lack of an unconditional right can now be properly classified as non-current under Ind AS 1, provided that newly defined right to defer actually exists.
Correct.
But if standard setters are now allowing conditional rights to dictate classification, how do we evaluate those conditions? Like, how does Ind AS handle a covenant check that happens after the balance sheet date?
This is where we get into the weeds with the newly introduced paragraphs 72, 72A, and 72B. They become the analytical core of the standard.
Okay, break those down for us.
Paragraph 72A establishes the fundamental anchor. An entity's right to defer settlement must have substance. And crucially, it must exist at the end of the reporting period.
Right, so for our standard Indian fiscal year, that measurement date is precisely March 31st.
Precisely. And then paragraph 72B provides the specific mechanics for how covenants interact with this right. It establishes a very strict timeline test.
Let's run our toll road company, Apex Infrastructure, through this new framework.
Let's do it.
Suppose their loan arrangement dictates that they must maintain a debt-to-equity ratio of 2.1. So, scenario A. The contract requires them to comply with this covenant on or before the end of the reporting period. So the actual mathematical test of their ratio is based on their March 31st position.
Okay, so according to paragraph 72BA, a covenant with a compliance date on or before the reporting period directly affects whether the right to defer exists at that date. And the standard is ruthlessly specific here. It affects the right even if compliance is assessed only after the reporting period.
Wait, let me conceptualize this with an analogy because the timing is wild. It operates exactly like a university student's final exam, doesn't it?
Oh, that's a good comparison.
Yeah. If the syllabus states the final exam is on March 31st, the student's academic standing is entirely determined by their performance on that specific day.
Right.
It doesn't matter if the professor takes a 6-week sabbatical and doesn't actually grade the papers until mid-May. The reality of whether the student passed or failed was locked in at the exact moment they handed in the exam on March 31st.
The timing of the assessment is completely irrelevant to the existence of the right. If Apex Infrastructure's debt-to-equity ratio slips to, say, 2.1.1 on March 31st, they have breached the covenant.
Even if the bank hasn't checked yet.
Even if the syndicate of banks didn't request the audited financials and run the actual covenant compliance certificate until June, Apex lost the right to defer settlement on March 31st.
Wow. Okay, what happens if we shift the timeline then? Let's look at scenario B, which I assume is governed by paragraph 72BB. What if the loan agreement is structured differently and Apex is required to comply with the covenant based on their balance sheet position 6 months after the end of the fiscal year? Say, the covenant test is scheduled for September 30th.
Well, returning to your academic analogy, an exam scheduled for September has absolutely no bearing on a student's official academic standing at the end of the spring semester in March.
Right.
Paragraph 72BB explicitly states that if an entity is required to comply with a covenant only after the reporting period, that covenant does not affect whether the right to defer settlement exists at the end of the reporting period.
So even if Apex is hemorrhaging cash in March, and the CFO's internal projections show a 100% mathematical certainty that they will breach the covenant in September, the loan remains a non-current liability on the March 31st balance sheet.
Legally and contractually, yes. On March 31st, they hold the right to defer. The future projected failure does not retroactively eliminate the right that exists at the reporting date.
That is fascinating. So let's trace the mechanics of a worst-case scenario. Let's assume Apex Infrastructure experiences a catastrophic project delay and officially breaches a March 31st working capital covenant.
Okay, the exam has failed.
The exam has failed. Paragraph 74 details the immediate consequence
Right
for
then. When an entity breaches a covenant of a long-term loan arrangement on or before the end of the reporting period, with the effect that the liability becomes payable on demand, it must classify the liability as current.
The logic is pretty straightforward there.
Right.
If the lender can legally demand the cash tomorrow, it is a current liability.
Exactly. But we all know corporate banking rarely operates with immediate, ruthless foreclosure.
Right. The CFO of Apex is going to be on the phone with the lead syndicate bank at 8 a.m. on April 1st, explaining the delay, providing revised cash flow models, and, well, begging for a waiver.
Yeah, that's exactly what happens.
So let's say the bank reviews the data and on April 5th officially issues a waiver letter. They agree not to demand payment as a consequence of the breach. The crisis is completely averted. Does that April 5th waiver save the March 31st balance sheet?
It does not. And this is a vital area where intuition conflicts with standard application.
Really?
Really. Paragraph 74 explicitly dictates that the liability is classified as current even if the lender agreed, after the reporting period and before the approval of the financial statements for issue, not to demand payment.
Wow. So the snapshot taken at midnight on March 31st cannot be photoshopped by an event that happened in April.
That's a great way to put it. No photoshopping allowed.
The right to defer was lost at midnight. The April 5th waiver is a completely separate transaction on a new timeline.
In the language of the standards, the post-balance sheet waiver is evaluated under Ind AS 10 as an event after the reporting period. Because the waiver did not exist at the balance sheet date, it is a non-adjusting event.
Okay, so it doesn't change the numbers.
Right. It requires disclosure in the notes to explain to the users that the current liability isn't actually going to drain the company's cash in the near term, but it absolutely does not change the classification on the face of the balance sheet.
So is there any mechanism within the standard to protect the non-current classification if a breach actually occurs? What leverage does a CFO have in that March window?
The only protective mechanism is found in paragraph 75. To maintain the non-current classification, the entity must secure a specific agreement from the lender by the end of the reporting period,
Meaning March 31st.
meaning on or before March 31st. The lender must agree to provide a period of grace ending at least 12 months after the reporting period, within which the entity can rectify the breach and during which the lender cannot demand immediate repayment.
That puts an incredible amount of pressure on the corporate finance team. I mean, if they project a covenant breach for March 31st, they cannot wait until the audit begins in May to negotiate.
Not if they want to save their balance sheet.
Right. The CFO must secure a formal, legally binding grace period letter from the bank, extending out at least 12 months before the clock strikes midnight on March 31st. A letter dated April 1st is legally worthless for the purpose of balance sheet classification.
It forces proactive risk management. I mean, the standard operates entirely on the contractual reality existing at the measurement date. Nothing else matters.
That relentless focus on contractual reality over subsequent events leads us directly into a really fascinating conflict regarding management intentions. Let's analyze paragraph 75A.
Ah, yes. Intentions versus contracts.
Exactly. I want to build a scenario where a company is performing exceptionally well. Let's call them Nebula Systems, a highly profitable tech firm.
Good for Nebula.
Right. They have a 5-year, 500 crore term loan sitting comfortably on their books. No covenants are breached. By all contractual measures, it is a non-current liability on March 31st.
A very stable baseline.
However, Nebula Systems management has been aggressively hoarding cash, and they've made a definitive, board-approved decision to pay off that entire 5-year loan early. They fully intend, and they have the actual cash on hand, to settle the entire 500 crore debt by June of the upcoming year. So my question is, because the management team intends to settle the liability within the next 12 months, does the accounting standard require them to reflect that reality and reclassify it as a current liability on the March 31st balance sheet?
If we trace the logic of the reporting date snapshot we just established, the answer has to be no.
Really? Even if they have board approval?
Doesn't matter. Paragraph 75A provides the definitive ruling. Classification of a liability is unaffected by the likelihood that the entity will exercise its right to defer settlement.
So the standard setters are explicitly stating that a company's internal intentions, no matter how well documented or highly probable they are, do not override the ink on the external contract.
The paragraph is remarkably explicit. It states that if a liability meets the criteria in paragraph 69 for classification as non-current, it is classified as non-current even if management intends or expects the entity to settle the liability within 12 months after the reporting period.
That is wild.
And it anticipates the ultimate extreme scenario, too.
Hmm.
It remains non-current even if the entity actually settles the liability between the end of the reporting period and the date the financial statements are approved for issue.
Wait, let me ensure the magnitude of that rule is clear to everyone. On March 31st, Nebula Systems has a 500 crore 5-year loan. On April 15th, they wire 500 crore to the bank and completely extinguish the debt.
Right.
In late May, the board meets to approve the March 31st financial statements for issue. On that signed, published balance sheet, that 500 crore is still listed as a non-current liability, despite the fact that the debt no longer exists in reality when the statements are published.
You've got it, because the balance sheet is a photograph of the rights and obligations that existed at the reporting date. On March 31st, Nebula possessed the contractual right to defer payment for 5 years. That right was an asset of time, and it existed.
They gave it up.
True, but the fact that they chose to voluntarily surrender that right in April is a subsequent operational decision, not a retroactive change to their March 31st legal standing.
While structurally logical, from the perspective of an end user like a retail investor trying to understand the company's capital structure, that presentation feels intensely misleading.
I can see why you'd say that.
I mean, they're looking at a balance sheet that shows 500 crores in long-term debt and a massive cash pile, completely unaware that the cash is gone and the debt is settled.
And the standard setters recognize this exact informational deficit. The framework does not allow the face of the balance sheet to be altered by intentions, but it heavily leverages the disclosure notes to bridge the gap between legal reality and operational reality.
Okay, so the notes do the heavy lifting here.
Exactly. Paragraph 75A mandates that the entity may need to disclose information about the timing of settlement to enable users to understand the impact on the financial position. Furthermore, the actual settlement in April is a textbook non-adjusting event under Ind AS 10.
So it requires detailed disclosure of the nature of the event and its financial effect.
Right. Which highlights a massive shift in the burden of transparency. The face of the balance sheet is becoming more rigid, strictly adhering to legal timelines, which really forces the notes to the financial statements to carry the narrative weight of the company's actual operational risks.
And this is perfectly demonstrated by the intense new disclosure requirements introduced in paragraph 76ZA.
Oh, yes. Paragraph 76ZA is the necessary counterweight to the removal of the word unconditional. Because standard setters are now allowing companies to classify liabilities as non-current, even when they are subject to future covenants, they realized they were potentially hiding significant short-term liquidity risks from investors.
Right, because to use our Apex infrastructure scenario again, if Apex has a non-current loan that is subject to a massive, highly stressful covenant check in September, an investor looking only at the face of the balance sheet would have absolutely no idea that a liquidity crisis is looming just 6 months away.
Precisely why paragraph 76CA was constructed. It dictates that if an entity classifies liabilities as non-current, but the right to defer is subject to the entity complying with covenants within 12 months after the reporting period, they must provide a comprehensive warning system in the notes.
Okay, what specifically does this warning system require? Because a generic note saying loans are subject to covenants clearly won't satisfy the standard.
No, it requires highly granular transparency. First, the entity must disclose information about the covenants themselves. This includes the specific nature of the covenants. Is it a working capital ratio, an EBITDA multiple, a minimum cash balance?
I need the specific.
They do. They must disclose when the entity is required to comply with them, mapping out the timeline of risk. And they must disclose the carrying amount of the related liabilities so users know exactly how much debt is at stake.
So the notes must essentially provide a map of every financial landmine the company has to navigate over the next 12 months to prevent their long-term debt from exploding into immediate, payable on-demand current liabilities.
Yes, but the requirement goes even deeper into operational behavior. The standard actually mandates the disclosure of facts and circumstances, if any, that indicate the entity may have difficulty complying with the covenants.
Wait, how does an entity quantify difficulty? I mean, does the standard require them to disclose their internal anxieties?
It requires the disclosure of mitigating actions. For example, if a company realized in February that they were on track to breach a March 31st covenant and they had to scramble to execute an emergency sale and leaseback of their corporate headquarters just to artificially boost their cash reserves and pass the covenant test,
Oh, wow. So they have to confess that.
that action must be disclosed.
That is a staggering level of forced transparency. If the CFO performs financial gymnastics to pass the exam, the audit report requires them to explicitly detail the gymnastics.
Yes. Paragraph 76ZA explicitly notes that users need to know if the entity would not have complied with the covenants if they were assessed based on the entity's circumstances existing at the end of the reporting period, absent those mitigating actions.
This entirely reframes our initial analysis of that seemingly innocent Schedule 3 disclosure we talked about at the beginning.
It really does.
Relying on a generic, classified as per Schedule 3 note completely circumvents this entire highly rigorous risk assessment framework mandated by Ind AS 1. It hides the covenants, it hides the mitigating actions, and it basically blinds the investor to the actual liquidity profile of the company.
Which is exactly why the Ind AS override in Clause 2 exists, to prevent outdated or generalized legal frameworks from degrading the quality and transparency of financial reporting. You can't just hide behind Schedule 3.
Okay, let's address one final, highly technical layer of classification before we wrap up. We spent considerable time discussing the right to defer settlement. But the mechanism of settlement itself isn't always as simple as just writing a check, is it?
No, not at all.
Paragraphs 76A and 76B delve into the specific anatomy of how a liability is actually extinguished.
Right. Paragraph 76A provides the foundational definition. For the purpose of classifying a liability as current or non-current, settlement refers to a transfer to the counterparty that results in the extinguishment of the liability.
Okay, extinguishment requires a transfer of value. I assume cash is the primary vehicle, but the standard contemplates other methods.
It does. It defines the transfer of cash, the transfer of other economic resources, which could include inventory, physical assets, or the rendering of services, and importantly, it includes the transfer of the entity's own equity instruments.
Equity instruments. Okay, let's build the final scenario around that last point, because the interplay between debt and equity is notoriously complex.
It is a minefield.
Let's imagine a startup, Quantum Therapeutics. They raise 100 crore rupees by issuing convertible debentures to a venture capital firm. The terms of the debenture state that the debt matures in 5 years. However, the VC firm holds an option. At any point during those 5 years, they can demand that Quantum settle the debt not with cash, but by issuing them a specific number of equity shares.
That's a classic compound financial instrument.
Right. So because the VC firm has the unilateral right to demand settlement via equity tomorrow, does that immediate settlement option force the entire 100 crore liability to be classified as current on Quantum's balance sheet?
This introduces the equity exception detailed in paragraph 76B. The standard is explicitly designed to prevent equity conversion options from unnecessarily tainting the classification of long-term debt.
Changing it how?
Well, paragraph 76B states that terms of a liability that could, at the option of the counterparty, result in its settlement by the transfer of the entity's own equity instruments do not affect its classification as current or non-current, provided a very specific condition is met.
Okay, what is the mechanism that protects the non-current status?
The protection is entirely dependent on the strict application of Ind AS 32, financial instruments, presentation. The entity must classify that conversion option as an equity instrument, recognizing it separately from the host liability as an equity component of a compound financial instrument.
Let me trace the accounting mechanics of that just to be sure. Quantum Therapeutics cannot just record a single 100 crore liability on their books.
No, they can't.
They have to hire a valuation expert to determine the fair value of the debt component if it didn't have the conversion feature at all. Let's say that's 80 crores.
Okay.
The remaining 20 crores is the value of the VC firm's option to convert to shares. So Quantum must recognize an 80 crore non-current liability and a 20 crore equity component.
Yes. And if they execute that split accounting perfectly in accordance with Ind AS 32, paragraph 76B of Ind AS 1 provides a safe harbor. The fact that the VC firm can demand shares tomorrow does not force that 80 crore liability into the current bucket. It remains non-current, accurately reflecting that the company will not suffer a sudden drain on its operational cash flow.
Right, because issuing shares doesn't drain cash. But what if Quantum Therapeutics' accounting team gets lazy or misinterprets Ind AS 32 and just records the entire 100 cores as a single liability without bifurcating the equity option.
Then the safe harbor of paragraph 76B just vanishes. Because the entire instrument is classified as a liability and the counterparty has the right to demand immediate settlement, the entire 100 core must be classified as a current liability.
It is an incredibly delicate ecosystem. I mean, Ind AS 1 relies on the valuation mechanics of Ind AS 32. It relies on the subsequent event disclosures of Ind AS 10. And all of it rests on the foundational legal override that modifies the Companies Act itself.
It's all connected.
If one gear in this clockwork is misaligned, if a CFO misreads a covenant date, if an auditor ignores an operating cycle, or if a single disclosure note lazily cites Schedule 3 instead of applying the standard, the entire diagnostic picture of the company's financial health just shatters.
It does. It emphasizes exactly why financial reporting cannot be treated as a simple compliance checklist. It requires a holistic, deeply analytical understanding of how these standards interact with both the law and the economic reality of the business.
As we conclude this analysis, I want to offer a final perspective on the tension we've explored today. We have seen how standard setters are relentlessly focused on the exact legal rights existing precisely at midnight on March 31st.
Yes, the midnight snapshot.
They completely ignore a management team's intention to pay off debt on April 1st. They ignore a bank's willingness to forgive a covenant breach on April 5th. They lock in the reality at the stroke of midnight. And to me, it bugs a critical question for anyone analyzing corporate health.
What's that?
How much of a company's perceived liquidity on a balance sheet is just a snapshot of legal paperwork, rather than the reality of their operational cash flow?
That is the fundamental limitation and really the core tension of the entire reporting framework. It is a legally binding photograph, not a live video feed.
A photograph, not a video feed. I encourage you to look at the next balance sheet you review through this lens. Do not view it as a static mathematical equation. View it as a photograph of legal rights taken at an exact moment in time.
It's
Just like the medical x-ray from the beginning of our deep dive, it captures a specific reality. But truly understanding the patient's health requires interpreting the shadows, analyzing the operating cycles, dissecting the covenant instructions in the notes, and verifying that the complex standard overrides have been properly applied.
And this requires professional rigor at every single level of the reporting chain.
Absolutely. Now, I should mention that the views expressed herein are the personal views of the author and are not binding on the audience. The audience is requested to seek the help of an expert before taking any action or refraining from any action based on the views discussed herein. Getting this right is absolutely critical, which is why I want to emphasize the value of professional independent review. Get your financial statements reviewed by GAAP advisors before signing them.
Definitely. For the audit partners and CFOs listening, this is a vital safety net to ensure your documentation and classification can withstand regulatory scrutiny. An independent review mitigates the inherent risks of internal blind spots.
And if you happen to invest in a listed company's shares, a review of a company's financial statements for Ind AS compliance can help you in making a proper decision on buying, holding, or selling the shares. The financial statements can be submitted in near-to-publishing PDF format by email to info@gapadvisors.com.
We truly hope this detailed breakdown has provided valuable analytical tools for your professional practice.
We kindly request you to share this deep dive among your contacts, colleagues, your audit and finance teams, and especially students pursuing the CA course to help spread the deeply technical knowledge of Indian accounting standards. Thank you so much for your time today. We request you to follow or subscribe to the GAAP Advisors Ind AS Clinic podcasts on Spotify, Amazon Music, and YouTube, whichever you prefer to listen to GAAP Advisors Ind AS Clinic podcasts. We will see you on the next deep dive.